Hey Bowtie Nation, Joseph Ho here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, I've covered shares of Hewlett Packard Enterprise, ticker HPE lately. In fact, it's one of the top 5 best values in AI stocks. But digging deeper, recently found 3 levers the company has that make it a rare can't miss investment. I'm going to walk you through why I'm adding HPE to my highest conviction stock list with a 36% upside to the shares. Stick around and I'll also update you on Zscaler, up 22% last week, and CoreWeave, ticker CRWV, up 260% just in the 2 months since its IPO. But first, I want to highlight a special offer on one of the sites I use for stock research. I've used premium access on Seeking Alpha for more than 7 years to get analysis and ideas, and more importantly, to make sure I'm getting the bull and bear case for a stock. You'll find pre-built stock screeners for top-rated stocks, and you'll be able to sit in on a company's earnings reports to get that inside information. Look for the link I'll leave in the description, and you'll be able to try premium access risk-free for 7 days. If you like it, that link will also give you a promo code for $30 off the regular price, so make sure you check that out. Back to our main topic though, and Nation, I highlighted the difference between Dollar General and Dollar Tree in last week's stocks I was watching and pointed out the strength in DG versus DLTR ahead of their earnings. It was one of those moments researching where you find that disconnect in the market. In it, I called Dollar General the much better stock on its relatively low 10% tariff exposure versus a potential negative earnings surprise in DLTR on its 40% imported products. And the chart proves you can beat this market with that kind of deep research, with the shares of Dollar General up 16% on the week, while Dollar Tree plunged on its earnings. The point here is it proves investing is more than just scrolling Reddit for a hot stock or looking at a few charts, but you can make money if you're ready to do this research. And that same level of research has uncovered a new high conviction pick on my list. In fact, Hewlett Packard Enterprise, ticker HPE, has so many levers it can pull, it can't help but push the stock price higher. Now, I've mentioned HPE a few times lately, and I want to walk you through the setup before sharing those levers that makes me so confident about this company. HPE is benefiting from strong growth in its data center server business, one of my favorite themes this year, but it's down 15% on the cyclical weakness in laptop and PC demand. As a result, sales are expected to grow just 8% this year and even lower, 5% next year to $34 billion. It's made the stock cheap at just 0.75 times on a price-to-sales basis, but with that slow pace of growth, it's not attracting investors in the AI theme, and while I do think PC demand picks up next year to boost that sales forecast, the stock needs something more to really take it higher. Folks, I love the game, and in poker, you bet a hand based on how many outs you have, how many winning hands you can put together, and the odds for each. And here, digging deeper into HPE, this company has so many outs, it's as close to a sure thing as you get. First of which are cuts the company announced in March, sending the shares lower then on a weak forecast that would see 3,000 job cuts, or about 5% of the workforce. And while cuts always send a worrying signal, the move is also expected to save $350 million in operating costs. Last week's earnings means the outlook might not be quite as weak as suspected, but the company will still benefit from those savings, boosting margins over the next year. Out number 2 of the 3 of a kind here is the July trial for the company's $14 billion acquisition of Juniper Networks, a leading networking hardware provider also set to benefit in that AI data center theme. The Department of Justice sued to block the deal in January, saying the combination of 2 of the top 3 wireless networking firms would give HPE an unfair advantage. The company is fighting it in court, saying the DOJ's thesis is flawed, and judging from how weakly the government has been fighting acquisitions this year, I think there's a good chance HPE wins and gets a great asset in networking. And out number 3, which amounts to a straight flush for investors, is the $1.5 billion investment announced by activist investor Elliott Management in April. While HPE would rather not be a target and not have to deal with Elliott, this kind of big money oversight almost always helps to unlock shareholder value. Elliott is going to be pushing for seats on the board and would likely force more cost cutting along with an increase in the share buyback program, a move that would boost earnings per share. HPE certainly has the cash with more than $13.4 billion in cash sitting on the balance sheet for that Juniper deal. Now that is a full 57% of this company's market value just in cash and gives it a huge amount of flexibility. So here what happens, you either see the company consummate that deal with Juniper, or it has a mountain of cash coming to investors in the form of a buyback. Given all these outs, the valuation here is just too compelling to pass up. Shares trade for that 0.75 times price to sales basis, and even though sales are only forecast to grow 8% this year, I think you could get closer to 8 to 10% growth next year if we do see PC demand come back up. A re-rating to just 0.9 times price to sales and $35 billion in sales next year would see the stock over $24 a share for a 36% return. Now granted, that might not be the 2 or 3x return I'm watching in some of our favorite stocks like SMCI or SoundHound AI, but this one is one of the lowest risks, high confidence calls in the market. Looking at the stocks I'm watching this week, first up, Gitlab, ticker GTLB, is down 13% this year, but taking the shares into value territory ahead of Tuesday's earnings report. The company is an open source code development platform for security and IT operations, leaning heavily into AI with one of the most comprehensive sets of tools to help those coders use AI to deploy faster and with fewer operations. Google parent Alphabet has been a big backer here, investing before GitLab was a public company, and still holds a 3.7% ownership stake worth over $300 million. Revenue for the quarter is expected up 26%, close to the full year pace, and the company is expected to hit $1 billion in sales next year. If it does hit that sales forecast, that would put the stock at just 7 times on a price to sales valuation, about half as expensive as it's traded at over the past year. Shares are already at a steep discount for just 10 times sales. On that expected 20% plus annual growth, this is a solid value in an AI stock. I highlighted Zscaler, ticker ZS, in last week's Monday market update ahead of its earnings, with the shares now up 22% just in the past 5 days. The company is one of my favorites in cybersecurity, my favorite long-term growth theme, which shares up 80% since I started buying. I do hold a larger position in CrowdStrike, ticker CRWD, now up 93%, and think it is the best of breed in the industry. But ZS is proving that the cyber threat is big enough for multiple players. Zscaler surprised with a 23% revenue growth in the quarter reported last week, and what I really like here is the company was able to post a good quarter when we've heard so much pessimism from others like Palo Alto and SentinelOne, telling me ZS is pulling away from the pack. And CoreWeave, ticker CRWV, has been the big story lately, with the shares up 262% in just the 2 months since its IPO. Normally that would be a big warning sign, but looking at these fundamentals is making me take a second look. The specialized cloud computing company provides GPU-accelerated infrastructure tailor-made for AI and those higher compute workloads. Besides some amazing growth, the stock jumped recently when NVIDIA reported owning 24 million shares, now worth $3.4 billion, or about 5% ownership of the company. And again, where that 260% surge in a stock would normally make me wait, this stock could very quickly become a value play. Revenue has grown by 11-fold in the last 2 years and is expected up 160% this year to $5 billion and to almost $12 billion next year. So just applying those forecasts to the $68 billion market cap, if it hits that $5 billion in sales this year, that's a price to sales of 13 times, which isn't cheap. But if it even comes close to that $12 billion in sales next year, that's a price to sales of less than 6 times, which would make it a steal. Showing you the bigger picture here with the Sector Spider's sector tracker, 8 of the 11 stock sectors did close higher last week, with energy stocks climbing on a 6.5% jump in the price of oil to join the risk-on sectors like technology and communication services. And every sector is now in positive territory over the last month, with a giant 11.5% return on tech stocks. It's the 7.4% return on stocks in the consumer discretionary sector, though, that worries me the most. Most companies completely ignored tariffs in their Q1 earnings report, so most were able to post surprisingly strong outlooks for the rest of the year. The worst of the tariff effects is expected to hit over the next 2 quarters, so that could mean some nasty surprises ahead for stocks in this group. And the picture is decidedly different over the 6-month period, with just 4 sectors posting positive returns. Now, I still like healthcare stocks and real estate as value opportunities, as well as stocks that can help protect your portfolio against any more market volatility. Updating our market outlook, last week's jobs report surprised higher and shows the labor market is holding up pretty well. That news sent the odds of Fed rate cuts this year lower to no cut until September, and possibly only 1 cut this year. Some of the market's bounce since May has been on the hope for lower rates, so if those cuts come off the table, it could weaken that argument. We will see a big part of that puzzle this week with the Consumer Price Index, the CPI measure of inflation that's released on Wednesday. The Fed has to balance economic growth with inflation. Now, it can boost growth by cutting rates, but only if inflation doesn't jump higher. And Wednesday's report on May prices is going to be the first key look into how tariffs are coming through. This is also going to be the first month we expect to see signs of that year-over-year inflation, with expectations up 2.5%, an increase from 2.3% pace we saw last month. But here, a big question mark is coming on whether you can even trust that inflation data. To calculate that monthly CPI, the Bureau of Labor Statistics sends out hundreds of workers to check those prices. If one of those can't find a specific price in a given city, they have to make an estimate or use a price on a similar item. Now, the problem here is that this year's hiring freeze on federal government workers has severely limited how many BLS workers are on that CPI team, and the few remaining have had to rely a lot more on estimates instead of those actual kind of data collected. The use of alternative estimates for prices jumped from a typical about 10% of the CPI survey to almost 30% in April. Almost 1 in 3 prices are just estimated, and it's likely to get worse. And not only does this raise the question of whether we can even trust inflation data, but it's going to mean big swings in the report, as one estimate maybe says one thing one month and another could say something totally different the next. Get ready for more volatility in stocks when those inflation reports come out on each month, right around the 12th of the month. Try out Seeking Alpha Premium risk-free for 7 days. Use the coupon code in the description for a special $30 discount and see some of the research I use here on the channel. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.